I apologize for being late here. Hopefully we didn't lose too many people. We still have a nice little crowd on here, so we're going to move forward as we had planned. Those of you who are the first time on here, if you have any questions, please type them in the bottom. You'll see the question spot. That will come to me. I'll make sure that gets answered. If you have a burning question where dialogue will help out, and you can control yourself through pushing the little green microphone on the left-hand side. Or if you've dialed in, if you look at the audio tab, you have the phone number with the access code, and you can control your muting by pushing *6. So today is going to be talking about some wealth building techniques. And we're going to get started right off the bat. So here we go. 5 to 6 o'clock, some ground rules to start right at 5:18, not at 6 o'clock. So I promise I'm going to change that next time. I still have not updated that from our 2012 sessions. Engage with everyone with questions. As I talk to you guys, please talk back and make me feel wanted, like you're listening. If you do that for me, that'd be great. If you are talking, please mute yourself if you have some background noise. If you're not going to have any background noise, I encourage you to unmute yourself. That way when I do ask questions, you can go ahead and unmute it and have that dialogue back and forth. Be prepared to implement strategies. You all are committing time to your schedules and your business schedules to learn what's going on. And tell me what you've implemented from a previous webinar. I'd love to hear feedback of it. If you guys want to see me in the hallway or the room or shoot me an email, give me a phone call, I'd love to hear it. Wealth building. I know real fast. I just unmuted you. Denny, are you out there? Denny, I'm going to call you out. Are you out there? Okay, well, he's unmuted. He is out there. Denny Tarasco is one of our agents here, and he does a lot of investment properties, a lot more so than I do. I'm actually in the goal of getting my first investment property this year. Everything I'm going to be teaching you is going to be regarding from the education I've got and people I've talked to. So, Denny, at any point, I'd love for you to jump in, give us some feedback from your experience, your expertise, and let's get started. So wealth building, I'm really going to dive into two aspects of it. Those of you with Keller Williams, okay, Denny is here. Denny, you there? Can you hear me?
Yeah, I'm here, but man, please, it's a little loud, so I won't be able to talk too much.
Okay, well, you know what? If you're listening, then do me a favor as I'm talking about it. If you've got a great story or a testimonial, or if I'm saying something incorrectly, I'd love for you to jump in so we can get your input and feedback on that. How many houses do you currently have, or have you sold and flipped in the past?
4.
Started investing?
4 in the last 2 years.
In the last 2 years, okay. And those are your first 4?
Yep.
Okay, and what's your goal? Is it long-term flipping, or is it long-term holding, or is it a little bit of both?
It's a little bit of both. Holding for wealth building, but depending on the market, taking advantage of flipping houses is also a good opportunity. So it all depends.
Okay. So I'm going to go ahead and mute you back up since you've got some background noise, but at any point, again, just shoot me a little question if you want to give some input. I'd love to hear some feedback from you. All right, so we've got profit share we're going to talk about, and then we're going to talk about some real estate investments, a lot what Denny was just mentioning. Profit share I'm going to keep rather quickly. I think everybody is here is from Keller Williams, so everyone has the opportunity to do a profit share. What profit share is when Gary Keller created the company, he wanted to create an office and a company that no one would ever want to leave. With that, he implemented the ALC, the Associate Leadership Council, which says, I want to know what agents are doing, what they want. They make the decisions so we can make a company that no one ever wants to leave. With that, they became the Associate Leader, acted as their board of directors, and to have an ownership and availability to be a stakeholder was really important, and that's where profit share came on. So what is profit share and how is it calculated? Profit share is when each individual office or franchise has their monthly expenses and their monthly company dollar, which we collect, we're going to have a profit. Anywhere from 25 to 50% of that profit will go back to the agents and goes to the agents who had a direct effect in us growing. And you're going to see that if you all signed up, you know who you named as your sponsor. So how is it calculated? When I said 25 to 50%, here's how it's calculated. And these are approximate numbers right here with $8,300. But the first $0 to $8,300 is split where the owner will keep 75%, agents will keep 25%. So if we profited in January $6,000, then we would share back 25% of that, or $1,500 back to the agents. The reason it's distributed that way is because the owner is taking all the financial risk, and that way it's balanced out. For the next chunk of money, about the next $4,000, it shifts from 60 to 40. So let's say we profited $12,000. The first 8,300 would be split 75-25. 83 to 11,200 would be split 60-40, and anything above that would be split 50-50. Overall, because we're profiting in a lot of offices that profit over 11.2 on a regular basis, equates to about 52 to 48%. So on average, the way you do that is about 42%. If you ever want to do a quick calculation, if you know that we had a profitability of 20 grand, you divide it by 2, and then plus or minus 2,000. So you take 20 grand, divide it by 2 is 10, plus or minus would be 12,000 for the owners, 8,000 for profit share. That's just a quick, raw way to do it, and that anything above 11.2, that equation will work out. So that's great. So how do we make profit? Who gets it? In profit share, not everyone has to do it, and frankly, only about 20% of the agents in Keller Williams of the almost 80,000 take advantage of profit share. So the way it works is when somebody names you as a sponsor, you're going to have availability of a sponsorship, and that's your level 1. Anytime that they make a sale, and that sale contributes to the profit of the office, then you will get 50% of that, and we're going to talk about how that equation works out. So let's say you are there and you hired, or Joe came on because you told him to. Joe then has his neighbor who wants to join, Steve. Steve makes a sale. Joe would get 50% as level 1, and Steve on your level 2, you would get 10%. Steve hires Susie, to the next person, to the next person, to the next person, to the next person. And it goes 7 levels deep. And that's what, if you look at a profit share tree, that's why it's done, because it's not a pyramid where you only have 2 people below you. It's a tree where it can sprout. You can have 15 people on your first line. Each of them can have 3 or 4 people, and it can grow and sprout. Also, what's great about profit share and the way it was designed with Keller Williams, once you've been with the company for at least 3 years, you are vested in the company. So if you're here for 3 years, you've got 10 people in your first line, and you decide to leave real estate, leave Keller Williams, get out of business, you pass away, you've had a great life. It's actually going to be vested. You'll continue to receive whatever profit share earnings you are getting, and you will also be able to be willed to your heirs. So that's why when you guys signed up, you had all of that information there. So what does this mean in real-life terms? Let's talk about a real-life situation. These are some pretty similar numbers to what we could experience in this market center at this time. Joe, who's in your level 1. Joe just closed a house, $200,000, 3%, which is a $6,000 GCI. Joe's not capped yet, so his cost of sale of the office is 30%, or it's $1,800. Office's total monthly company dollar is $54,000. So of all the agents who close deals, we earn $54,000 a company dollar. Our expenses were 30 grand, therefore we profited by 24,000. All in all, you can see that 1,800 into 54 is about 3.3% of that company dollar. You're going to see why that's important. We profit 24,000. If you recall from the previous slide, about 48% of that goes to profit share. So profit share pool is 11,520. 3% of 11,520 is 380. 380.16 is what directly affects to Joe in his downline over here. Since you are Joe's level 1, you get 50% of 380, you would receive 190. If you're Joe's level 2, you receive $38. 16, 16, 24, 38, and about 45. All that adds up when you can have little pieces of pie from everybody. Now that might be confusing for a lot of you seeing this for the first time. I am going to cruise through it pretty quickly. If you do have any questions about that and how it's calculated, come talk to me and I'll be happy to do it. This is all allocated on the 21st of every month. It's direct deposited right into your account. Let's say you hire Joe, Joe hires 4 more people, and then Joe decides that he goes out of business again. He would go away if he's not there for 3 years, and your previous level 2 bumps you level 1, so it bumps away up. So then you start getting 50% of that. Okay, so I've got a handful of you on here a little bit. How we doing? This might not be what you were looking for, but we're going to keep going. That's profit share. If you ever wanted to learn about what do you do for profit share, how do you invite people, all you have to do is introduce them to a reason to come to a training, to come talk to me, to invite them to one of these webinars. If somebody joins Keller Williams, it's going to be a fit for their business. They're going to be profitable for it, and then you're going to earn from it. You don't have to recruit them. You don't have to overcome objections. That's my job. That's what I do, is I help people understand if they have the right fit for the goals, and we talk about that. So know that, I protect that, and that's the way to build your long-term wealth. What's neat about profit share, every month when people receive a profit share check, I text them, and let's say the previous example is here where you earned $190. Well, that's money that you earned without any money in the bank. If you were to take $190 times 12 months in the year, is $2,280. And if you were to divide that by 2%, which is what you would normally earn in a CD, it's equivalent of having $110,000 in the bank. It would take you $110,000 in the bank at 2% to earn $190 in interest. That's kind of the power of profit share over the long term. Okay, let's take a look at real estate investments. Again, Benny, if I'm saying anything wrong, if you have some great things to add in, or if anybody else out there, actually of the people who are on, we've got about 7 or 8 of you, who has an investment property currently, so I can also ask you guys for some help with what your experience is. Just go ahead and respond in that question session that says me, and I'll make sure I know how to unmute you if we're available. So as you guys are rolling that in, if you have an investment property currently, or if you ever flipped a property. Okay, so Hold was released last fall, and during the release of Hold was a session called Play Big in Today's Market. So I brought that book back out. I took a lot of the information from Play Big because it talks about how to build your wealth and play Hold. So some myths or some truths about investing in real estate. It's accessible. Absolutely, it's accessible, especially for us because we have the MLS. We eat, sleep, and breathe it every day. We are in real estate. It's appreciable. Now, you might argue this over the past 5 years, and I can appreciate that as we've had the decline. Last year, we did have an increase in depreciation. The home values went up by about 15%. Gary Keller and some other people who have studied the market says that over the next 10 years, trends should continue to go up about 8%. Over the long term, 30 years is about a 4% appreciation you can count on for your long-term investments. Because we had 4 years in a row where we were dipping in double digits, below 15, 20, sometimes 30%, we're going to recover. We're not going to recover rapidly because then this becomes volatile again, but we will be appreciating. All signs show that rock bottom is behind us unless something catastrophic were to happen. So it's a great time to get into it right now because you will have appreciation. It's leverageable. One thing I love right now, and this is what I'm looking forward to do this year, like I mentioned before, is borrow money from the bank at its historic low mortgage rates. Mortgage rates have been in a historic low. They've been under 4. And even if you get some higher terms or if you get lender pays your PMI, you're still getting 5%. Now, if you take that with what we just said with the appreciation of at least 4% long term, all you have to do is get a 1% return on your investment, and it's going to be taken care of. So it's leverageable to borrow money from the bank. It's rentable. Over the past 3, 4, 5 years, what's happened to single-family residents? So that's not good. Let's close that off. What's happened to single-family residents? They bought in 2005. The economy came. Lost a job. Can't afford it. They've been foreclosed on. They've been short-sold. With the exception of this last year where 50% of the homes sold were distressed property, which means you have a lot of people with careers, with jobs, kids who are in school, who cannot be approved for a mortgage. What do? They rent. If they short sell, they rent for 2 years. If they were foreclosed on, up to 7 years. That means it's very rentable. These single-family homes, people need to be homes. They don't want to move, and they can't buy until they can recover their credits. They're going to be renting. It's improvable. Absolutely. I mean, anything you do on it, we all have seen it where if you put an improvement, the hardwood floors, the granite, the addition, the screen enclosure over the pool, these are all improvements where you can actually buy it, improve it through the rentable income or whatever you want to do that fits in your balance sheet, and sell it for a higher value. So you can improve on this. Deductible, depreciable, deferrable. Those are 3 nice D's there. We just had a CPA in here today talking about the tax deductions. You're going to create an LLC for all of your properties. Anytime you spend anything on these properties, whether it's looking for them, buying for them, searching for them, shopping for them, it's all deductible. Talking about them, tax deductible. So as self-employed business owners, you have a lot of ways to do tax deductions. This is another one. It is stable. Despite what a lot of people might tell you, real estate is stable because it's a long-term hold. Denny, you said you've got 4 properties for long-term holding for wealth, and that's because he can ride the waves. He may have bought it in 2005, 6, 7, he said 2 years ago. But people who did buy in 2005, when they bought it, it was a great buy at the time. Now, sure, they might be upside down right now, but if they're still receiving positive cash flow, or if they're still receiving enough that it makes sense for them to own this property outright in 15 to 30 years, it is stable because this is retirement. What we're working on is retirement right now, and depending on where we're at in our lives, some of us might not be retiring for 15 to 20 years. Well, then you're going to have houses paid off. You don't care about what the market does right now. You only lose or make money when you sell. Livable. If you needed to, you can live in it. If you needed it to go down, you can live in a house right there. You can take care of your family, friends. Real estate is the most able investment. And that's kind of a quote from the whole book. Let's take a look at some harsh truths about retirement, about wealth. 58% of people have not determined their retirement needs. And I'd be surprised if that still seems low to me. 58%, that's 6 out of 10 people have no idea how they're going to retire, when they're going to retire, how much they need to retire. 15% are earning more than $50,000 in retirement. Let's take that on the flip side, that 85% of people are earning less than $50,000 a year. Now, depending on $50,000 is a healthy income for a family, typically retired, you're empty nesters. So you might have a lower cost of living, and that's a very comfortable way to live. If you're comfortable or used to living off of a $120,000 salary and now you're at $50,000, it might be a rude awakening for you. You have to really lower your cost of living. So you have to figure out now what is your lifestyle you want to maintain once you stop working, and how are you going to earn that? 17.5% of people over the age of 65 are delaying their retirement. Why? Probably because only 58% of them determine their needs. Now they're 60, 61, 2, 3, 4, 5, and they're not retiring. I believe wholeheartedly that us as realtors and entrepreneurs and self-employed business owners are the majority of those people, because we don't have a pension. We don't have an employer who's putting away a 401k for us. We don't have, we don't have people who are really almost forcing us into retirement. We've got to do it ourselves. So you've got to think right now, how long is it going to take for you to get what you need to be able to retire at 65 or 55 or 45 or whatever that goal might be. Real world example. You need $80,000 to retire to maintain your lifestyle. $80,000, you get a vacation when you want, you're going to be able to go out when you want, take care of your family. You're 50 years old now, you want to retire when you're 65. There's a 3% inflation increase every year. Don't forget about the inflation. You're going to need $120,000 a year to maintain your lifestyle. 65 years old, either A, you're going to have it all in a savings account. You're going to live until you're 85. So 20 times 120,000 is go have $2.4 million in a bank account. That's one option. Or what can you do to have passive income, whether it's through profit share, passive income through long-term investments with tenants who are paying you money. You're going to buy a house now, and you do it every year for the next 15 years on 15-year notes. Eventually, you're going to have clean and clear paid-out properties that'll still earn you $1,000 a month. So think about what does the next 10 to 15 years look like for you, 20 years. When are you going to retire? The McKissicks, who are some of the co-authors, Linda McKissick, decide later. She and her husband had the plan that they started about 20 years ago, that they're going to get 20 homes in 20 years. They're going to do 15-year notes on it. With the 15-year notes, they put all of their extra income they get, that they can afford through the vacancy and everything else, instead of making a cash flow, towards paying off the first house. Every 5 years, one of their houses, on the 5th year, the first house gets paid off, so on and so forth. Now they own 20 homes that are owned free and clear with about $1,000 a month income. That's $20,000 a month income on their homes clean and clear. This was you needed $220,000. They're making $240,000. On top of that, that's their passive income. They also own 20 homes that are probably an average of $150,000 a piece. If you do that math, they have assets in real estate of $3 million on top of a $240,000 income. That's a retirement plan. If you guys can do one a year for the next 20 years, do it. If you can do one a year for the next 10 years, do it. Whatever you can do, what is your retirement? How are you going to survive off that passive income? Some strategies to get started. How are we doing so far? Any questions or comments? Or I'm not seeing anything so far, so we'll keep it going. Okay. The power of leverage, it multiplies your profit. We talked about that already. But let's think about that. You want to buy a house, and it's $120,000. I think I have the example here. On a 15-year note, you put 5% down, and you borrow 95%. So $120,000 at 5% down is $6,000. Your rental income outweighs your mortgage, and you get 4%. So you put $6,000 down. You borrow at 4%. Your mortgage of $700 on a $116,000 note will get you $1,000 a month. You're going to borrow it at 4% and earn $300 divided by 6,000 times 12. You're earning 6%. You're earning 2% of the bank's money. As this goes on and years go on and years go on, these tenants are also buying down your principal. So instead of owing $116,000, you're owing $100,000. You're owing $80,000. And over 15 years, you're owning it outright. Now you've got a $120,000 asset that also earns you 2% of the bank's money. And now the bank's paid off. Now you're earning 6% and your appreciation. Add that to your 4% appreciation of the real estate market, not to know if your return on your investment, and your 6% turns into 10. Or your 2% you get in the loan turns into 6. That's why it's stable, because it's a double source of appreciation, not only with cash flow with the renter, but also with the appreciation of real estate. Happens the opposite way with vacancy and expenses if you are looking for cash flow. Let's say you're looking for passive income right now, so possibly you can stop working and you can almost become your own property manager. Same concept goes when you can leverage against cash with the bank. You have your vacancy and expenses with the variable cash flow. Your vacancy and expenses remain constant. You're going to have the same 1 month vacancy. You're going to have the same formula there. Denny, I'm going to unmute you here real fast if you have, and I don't know if you do, again, I'm putting him on the spot. Do you have a formula, and I know that Marty talked about it last time, what you could expect percentage-wise for your vacancy and expenses when you own a home and you buy and hold it?
40%.
40%.
Goes to vacancy, management, repairs.
So if you have a home and you can collect $1,000 rent, go ahead and expect $400 of that rent to go right into repairs, vacancy, property management fees, etc. Does that include your taxes?
Yes.
Okay, so that's everything. That leaves you 60% net profit.
As long as there's no mortgage.
Okay, when it's paid clean and clear. So if I'm looking at a mortgage of $700 and I can get $1,000, then I'm actually paying $100 a month to eventually own this house outright and to get to my long-term investment.
Exactly.
So if you will, that's almost your 401k contribution, your $100 a month. That in 15 years when you want to retire, you can cash it out. Okay. Did I get that right?
Yep, you got it.
Cool. Thanks. Appreciate that.
No problem.
Okay. And I mentioned Marty. Marty's a very successful and aggressive agent here in the office, Marty Rafice. If you have the roster of our Waterford office, take a look and make sure you're at his class, the next investor class he does. His goal is to do 20 or 30 homes before the end of the year. And he does everything from flipping them to rehab to wholesaling to buying and hold. Really takes a look at opportunities and then says what's the best way to capitalize on this for his portfolio. Marty has some interesting concepts of how to borrow money. The bank is not the only way to borrow money. His favorite, and I'm quoting him here, so it might be wrong, and this is going to be published forever, but I believe his favorite was seller financing. You knock on somebody's door, you do seller financing, and you're going to guarantee X, Y, Z over the next term. So seller financing can be, so long as you pay market value, you have a very, very low interest rate. They're guaranteeing the tenant, which they didn't want to do. They've got to move in a hurry. Then you can actually handle the management of it and make a higher profit. So there's different ways to get creative. We already talked about this. You're going to borrow money from a bank, hard money lender, lower percentage than your ROI. Your ROI is your return on your investment. That kind of takes me into the next spot. There it is. Okay. Expect a 60% net in your properties, which I'm glad, Denny, you confirmed that. So you've validated. I kind of know what I'm talking about here. Thanks for the education. So expect a 60% net in your properties after expenses, vacancies, taxes, etc. Return on your investment is your goal. This is a money game. This is your portfolio. The same way that you guys, when you look at stocks and bonds, you're not buying stocks of your favorite products. You're buying stocks of what looks to be the best based on the stock market and based on the trends or based on the release of profits and which quarter it is. And if you don't wear gold, you'll still invest in gold if it's a good investment. Take that same mentality with these houses. Do not get attached to these houses. These are not your homes that you live in. These are not your homes that you raise your kids in. You're looking for a return on your investment. Remember when I was an agent actively working, I was working with some investors, and one of the two couples, the husband and wife, was very emotionally attached, and he or she said, I don't want to profile, I don't want to buy this house and rent it out if I couldn't see myself living here. And they wanted to put in granite countertops, and it would cost them $2,000. At the time, we were looking for about an 8% return, and I said, off $2,000, are you going to be able to get an extra $160 a month rent for these extra granite countertops? Because that's the return on it. You've got to look for return on your investment. The only attachment you should have is the cash flow and or equity you're building. Some of the most profitable things you can have is a multiplex or a duplex. One property, you get two income streams. So the strategy that was advised was, as you don't get too attached, you look at things that fit your profile. You look at and you pick 30 homes. These are the 30 homes that are in MLS. Great. You're going to look at the 10 homes. You're going to make an offer on all 3. 24-hour window to get out. Everybody knows how to protection with the inspection period. But put the offer in. Start playing a game. Don't worry about which home is going to be the best for you to one day to retire in. You're not buying a beach house for yourself at this point. Your beach house comes way down the road when you can buy it free and clear in cash. Right now you're buying investment properties. You're buying properties, which are great targets. Appeal to the masses. So let's think about some things of appeal to the masses. Right now, average price point. Who knows it? Average price point in Orlando. Couple different sources you can get it from. Everyone's gun shy. It's about, there it is, Denny, thank you, $125,000. $125,000 would be appealing to the masses. This office is $141,000. Oviedo is $187,000. Know what you're looking for with these houses. When we say appeal to the masses, don't go out and buy a $350,000 house on a lake, because not many people can afford a $3,500 rent into the smaller window. $125,000 home is going to be your bread and butter of a single family, 3-bedroom, 2-bath, 1,500 square foot. Those are the masses, the most people who can afford that $900 to $1,200 rent. Appeal to the masses. What else is important to people as you work with buyers was something that a lot of buyers, especially here in East Orlando with children, they want. One thing that jumps out is the school district. They want a good school zone. If you can buy a home that has historically a good school zone, and of course we can't guarantee it because school zones may change and quality of schools may change. However, historically a good school zone, you're going to have a higher rentable income. You're going to have a higher demand of people who want to be there. And you're going to have a higher appreciation. Appreciation is directly affected by that supply and demand. Also, we talked about appeal to the masses. If you have people with a duplex, with the quadruplex, you might have a couple who can afford $600. Well, if you would get a condo for 40 grand, and you have people all day long who are renting for 600, that's a big demand. Know what you're getting for it. Don't be unique. Don't buy the house that's so unique and custom and perfect for you to live in, because that's not the masses. Appeal to those masses when you're looking. You make money with an investment when you buy, not when you sell. Look for positive cash flow now, lock it in, and nothing year changes. A 15-year fixed, a 30-year fixed at 4%, nothing changes. So I hear people of different scenarios, but people may have bought some property back in 2005. And when they bought it, it's a great deal. They might think, you know what, I'm paying $200 a month. However, in 15 years or in 30 years, I'm going to own this house outright for only $200 a month. $200 a month times 12 months is $2,400 a year times 30 years. You're buying this $250,000 house for $72,000. Awesome. And then you hear that they had a short sale because the house no longer is $250, it's worth $125. Well, you're still only paying $72,000 for a $125,000 home. You make your money when you buy. Don't worry about what the market's going to do. If it's a great value right now, it's going to be a great value for you. And stick to those rules. Make rules for yourself. We're going to talk about where to find that. I imagine that any of you investors out there, and Denny, you likely have one, I know Marty does, you've got your spreadsheet. You plug numbers in. If it works, it works. If it doesn't work, it doesn't work. And do not get emotionally attached. You have to be a smart investor with that. There's some resources out there. If you go to kellerinc.com, you're going to see that's the website where you can find a lot of the books that have been written by Keller Williams. A lot of the class tutorials have been written. In particular, you have MREI. It's the blue book, Millionaire Real Estate Investor. It talks about the spreadsheets. They have some examples in there. Flip, it's the green book. It talks about exactly what it sounds like. If you buy it, you rehab it, and you sell it for a higher value. You're flipping it. You buy a house that's been distressed, has some mold in it, the landscaping's dead, the carpet is from 1984, and it smells like smoke. Get in there, buy it, pennies to the dollar, put in 20 grand, and sell it at market value. That's your flip. And your hold is more of what we're talking about for your long-term investments. That's the yellow one. That was the one recently released here, and long-term investments. Another resource, mykw.kw.com. This is eEdge home base. eEdge is a whole lot more than a database management and a marketing management and everything else you guys know it as. So if you go here, click the Education tab, Keller Williams University, Books, and Toolkit. In particular, if you click the Toolkit of Millionaire Real Estate Investor and Flip, you'll find a toolkit with spreadsheets available for you, with some PowerPoints available for you. It's not only a great opportunity for you as your own investor, but a lot of you might have investors as your clients. How useful would it be if you could share this information with them? If you download that PowerPoint, if you could do a PowerPoint presentation seminar, and you invite people there, top your 10 clients, they each get a book for themselves. You bring in your affiliated partnership with your CPA, with your general contractor, and you have a seminar. Now you have clients who are ready to buy a property, and who are they going to choose as a realtor? They're going to choose you. I flew through this, perhaps because we don't have any real-life examples, because we can't go out and buy a property right now. But I want to open this up, and again, this is only about a half hour, so I apologize for that. Denny, I'm going to put you in the spot. What did I miss that's important for these people to know who are looking to build that wealth or get some real estate investments? Anything you can think of?
No, I consider myself a beginner. I'll prefix that before I say anything. And I don't have rental property. What I've done is flips. All 4 of the properties I've done is flips. So I just want to say that before. So.
Okay.
But starting out, I mean, they need to know the area that they're going to be working in. They need to know price points and do their homework. I mean, it's just like when you're talking to a seller, you have your scripts, you have it. Like, I'm learning what they know now. I'm learning everything they know. So it's, you know, doing their comps, knowing what a property's worth, and knowing the formula. 70% of the ARV, the after repair value, what the property's actually worth when it's fully repaired, fully looking nice, you know, nice floors, nice roof, everything good. It's 100%, 70% of that minus repairs. That's the most you can pay. So rather than looking at it like it's beautiful, you got to look at it for what it is. It's a number. If it doesn't fit the number, that's it. Same thing with the rental. If you can't afford the 40%, you know, the $100 a month, then you can't do it.
Awesome. Yeah, that's a great point, and it kind of reiterates, know those numbers, know the spreadsheet. So what he said there is 70%. If a home in a nice value, thank you, Denny, is worth $120,000, and it needs $15,000 in repairs, then you take your $120,000, you multiply it by 70%, which is $84,000. You subtract your $15,000 in repairs. In that house, you cannot buy it for any more than $69,000. If you can put 15 grand in, then you can go sell it for $120,000. That's his formula. So if it's worth $75,000, he doesn't go, oh, it's so close, because then he's working for free. Then he's putting in time, effort, resources, paying interest, paying contractors, and then hoping it one day sells for a profit. His profit, where it makes sense for him to put in the time and effort, is 70% minus expenses. That's your flip. And if it's your hold, you need to know, what's my return on my investment? What am I going to get from the bank? What's this going to be worth? And what's the rental value of it? So do that homework. Anyone else have some comments or questions? Again, I don't have any personal experience of this. However, this has been a growth plan of mine for the last 2 years, and I'm working with the lender right now to buy it. So I have done my homework as far as what I'm looking for, so I can answer with a lot of you of questions you might have. I think we're good then. We're going to keep moving forward. It's been a quick one there. Next week and the 29th, I'm excited for these next 2. I've already got our panelists on board. Listing presentations, we have 3 people. One is Isabel Ward. She does a lot of short sales, so she's going to share with us a lot of what's important when she goes in a short sale listing and what she tells her clients. Jenny Weimer, who listed and sold 81 properties last year in 2012, is going to talk with us about what she does and how clients choose her for a listing appointment. And then Heather Lamb, who's an agent out of Oklahoma City. She's given me her numbers. I know she did about $10 million with she and her business partner last year with a similar price point. And she gets 7% on almost all of her listings. 7% commission in a very similar market. She can tell us her scripts, her marketing strategy, and how she can go in and consistently get 7% and a higher commission rate than her competitors. So that's next week. Make sure you come along and you invite a friend. Buyer's presentations. I've got 2 panelists lined up. Dean Gonzalez, he closed 55 homes last year, 80% of which were on the buyer side. Christine DeAngelis is the Weimer's most productive buyer's agent. In her first year of real estate, closed 42 buyer sides last year. So we're going to talk with Dean and Christine of what they do to get their buyers to choose them, the exclusive buyer contract, to write offers that are strong and competitive in this market so they can get closed. Of course, you see the rest, niche marketing, run a business like a business. Got family reunion coming up. 411, which is accountability, time management. FSBO's expired, some scripts. What else would you guys like to learn? We've been doing this since October, so if we want to get some repeated things on there, that's okay. What else is important for you guys that you'd like to see on here? Start typing them on of what you'd like. I'm going to write it right here. Fire away. Okay. All right, not many responses. There's a handful of you on here, so I guess you're okay with anything in that aspect. All right. What would I answer it for you? Has this been? I cruised through the profit share really fast. That has a lot more to do with it. This year, this office has closed or given away over $100,000 in profit share back to the agents. Just this office. As a whole, Keller Williams gave away and shared $52 million in profit share. When you think about that, that goes right to the culture because not other companies do this. Some people who claim they have profit share, they actually take it out of the person's commission. This comes from the owner's profits. And that $52 million could be used towards higher profit, towards buying out smaller companies. The Keller Williams growth has been organic. We've never bought out another company. We've gone from brand new 30 years ago to 10 years later having 4,000 associates, to 2002 having 12,000 associates, and now in 2012 closing out with 78,000 associates. It's an incredible company to work for. Everyone has the opportunity to be a shareholder, and also that goes worldwide. So if you guys have some connections that are overseas, we are launched worldwide. The highest profit share earner is Thea Osborne, and she just invited and introduced and brought in the owner of South Africa. The southern half of Africa. And now that person's in her one down line. This person will be responsible for growing Africa, and she's going to be part of that profit share tree. Huge opportunities if that's the focus of yours. If not, that's okay. Denny had a comment. Anybody looking to start getting into investing? Recommend to join CFRI, which is Central Florida Realty Investors. It's a local investors club with tons of free groups similar to Keller Williams. Denny, what's the best information? They just Google that of how they want to get a hold of that because I'd actually like to join as well. What's the best way to join CFRI? Got you unmuted.
Yeah, go to they can go Google CFRI or CFRI.net is the website. C like Charlie FRI.net. They have a meeting the first Wednesday of every month at the Science Center. If they email me, I'll send them a free pass for the meeting. I'm on the board of directors at CFRI, so I'll send them a free
What's your
pass.
email address?
It's a program, PROGRAM, at CFRI.net.
And that'll go to you?
Yep, that'll go to me.
And they meet, when did you say they meet?
First Wednesday of every month. That's the general meeting. That's the big meeting. And they have groups every week, different types of groups with different focuses. They have commercial, they have landlording, they have flips, short sales. They have all different types of investing for all different types of people.
Okay, and is it a membership, an annual membership they pay?
Yeah, there's an annual membership. It's $150 a year.
Okay. Very affordable. Great stuff. See there, you were a panelist on here. You didn't even know it. All right. If you guys want to see some of these past webinars, I still owe you the social media. I trust everyone who was on last week's social media got those handouts from Portia. She emailed them to you, just the tips for that of how to start your blog. I'm sorry, your blog, not social media. I also put them on my YouTube page, so if you want to find these past webinars recorded, check on my YouTube page. They're on there. And then you'll find the blogs and all the information of upcoming events on our Waterford page at KennedyWaterford.com. Anything that you see in here that you want more in depth or want to talk about, come talk to me. We can do a little consultation. and we can really talk about what's important for you in your business, as well as if you know of anybody right now who is not hitting their full potential in real estate and is talented and just missing some systems tools, I'd love to introduce them some things you have, and if it's a great fit, start building your downline right now and give you some profit share. Deborah, you mentioned you did not receive the handouts. Email Portia. You can email Portia at OrlandoAdvantage.com. Sorry. And you'll be able to get a hold of Portia. Email her, request those, and you'll be good to go. Okay, I appreciate the patience with us logging on. Hopefully that won't happen again. I think a couple of you had the same issue, so I don't feel too bad. But here we are, finished a little bit early and a little after 6 o'clock, so we're still pretty well on time. Next week, again, very excited for that, so make sure you time block for it. We'll make sure we start on time and end on time for our listing presentation with 3 great panelists. Guys, have a great Tuesday, great week. Thanks for coming on. Appreciate your time. Be well.